If you look at the top right chart, that's showing the rolling 1-year return of the Wilshire 5000 index, basically the broadest index for US equities. All the way to the right there, you can see the most recent return north of 62%. So an historic return from the pandemic low just a year ago, the best 1-year return since the early 80s. But importantly, when you peel back the layer there, it was really a tale of two halves. So in Q2 and Q3 last year, when the economic environment was still a little murky, when rates were still very low, market leadership was really large cap stocks, more growth stocks like the Apples, the Amazons, the Microsofts, the companies that really benefited from the pandemic, if you will, from the work from home environment, from the retail environment, things of that nature. But once we got more clarity around the economic outlook and interest rates bottomed and started to rise, the market leadership shifted away from those types of companies and more towards smaller companies, more mid-cap companies, value-type stocks. So this historic return couldn't be different based on who was leading the market or which areas in the first half and the second half. And I mentioned that because we think about some of the changes were made in February. If you recall, at that time, we did a really deep dive into the equity structure, right? Where were the bets? Where were the tilts relative to the market? And there were big growth overweights in U.S., in international and in emerging markets. And even though we were only two-thirds of the way, or we were already two-thirds of the way during the quarter where value did exceptionally well, still having that 1 month left, making those changes did prove helpful for the fund in the first quarter. And we'll see those numbers in just a second from an equity perspective. The other thing on the bottom of page 11 that really illustrates the importance of what rates are doing sort of to the market leadership. If you look at the bottom of that page, what we're showing in the orange line is the 10-year Treasury yield. And then the blue line, it's the relative performance of value stocks versus growth stocks. So when that line's declining, it means growth is outperforming and vice versa. And you can see that orange line, the yields were declining rather notably for a couple years and then stayed pretty low amid the pandemic. So it was a very big tailwind for growth stocks. So that blue line came way down as growth outperformed value. But then you could see sort of in September 2020 there, so Q4 and then more notably in Q1, as rates, that orange line rose, value bottomed relative to growth and outperformed quite drastically. In Q1, value within the U.S. was about 10 percentage points ahead of growth, I think somewhere in the neighborhood of 11% versus 1. So a huge shift in that market leadership. And again, some of the changes that were made to bring the equity structure back into balance, decreasing those growth tilts, taking a more balanced approach proved helpful. Now, with all that said, are any questions or comments about the market environment before we move into the trust itself? Okay. So if you hop behind Exhibit 2, we'll talk about on page 18, again, the observations for the trust. See the market value at the end of the quarter was $110.7 million. We'll show you an update shortly. You can see the portfolio gain there, $3.1 million, and then the return 2.9% net of fees versus a policy index of 2.3%. Now, in that last bullet point, it's always important to mention with a portfolio that has a large allocation of private market investments, here about 25% if we look at private equity, private credit, private real estate. Those values, as you all know, are reported on a lag, so they're not updated through Q1 at this time. So when we think about that, equity markets were up 4 to 5%. It's probably a reasonable expectation for those assets during the quarter. They're 25% of the portfolio. Quick math tells us that eventually, or hopefully, that Q1 return will probably get revised up closer to 4% when we have all the data come in. So always important to keep that in the back of our minds, given we don't have that data right now. We'll have it in August for when we do the plan report at that time.
So the 2.9 does not include any of the private?
Correct. Just the hedge,
Okay.
just the hedge fund,
Okay.
but none of the privates yet.
Okay.
The lag tends to be a little longer on the calendar year basis because they do their audits and things like that. So we've started to see them come in, and we have the updated values for the market value and recommendations page so far, but they haven't all come in yet.
Okay.
As far as an attribution perspective, again, what helped on the positive side, number one, an equity overweight, similar to the LoSAP, having more money in the good performing or the best performing asset class. The U.S. equity structure, again, this echoes my comments about the changes, decreasing those growth tilts and moving to a more balanced approach. Outperformance by your active fixed income managers, and then the fixed income structure. Again, adding that shorter duration manager at a time when rates were rising left the fixed income portfolio less sensitive to those rate changes. So that was helpful. And then on the negative side, just the non-U.S. equity structure, the non-U.S. equity asset class was a little bit behind the benchmark for the quarter, but that was really the only detractor that was notable to speak of. And then looking ahead, we'll get to the asset allocation study, and we'll circle back to the roadmap for the IPS later on in the meeting. If we look at page 19, again, sort of the executive summary here, you can see that we began the year at about $107.2 million. The net cash flow was slightly positive, and I'll talk about that in just a second. And you see the net investment change of $3.1 million. So for that cash flow, it might be a little counterintuitive at first glance because it's positive, but no money's going into the trust. What's going on is really the timing of some of those calls and distributions. So what we saw at the end of last year, there was a capital call for one of the firms that was sent out prior to calendar year end, but then they didn't show it as a contribution in basically the first business day. So it's just a calendar timing perspective that would wash out over time, but just wanted to make quick mention of it because, at first glance, it doesn't make a heck of a lot of sense. So we'll circle back to the returns in a minute when we look at the peer rankings, but if you look at the asset allocation below relative to the targets, again, the quick takeaway in those first three rows, you see the current relative to the policy for U.S., non-U.S., and emerging markets, about 5.5 percentage points overweight. Again, in Q2, so far equities have done well, so having more money in equities has been helpful for the fund relative to the peer group. And most notably, that overweight, if you work your way down to the private real estate, sort of in the middle of that page, that overweight to equities is largely, or by all intents and purposes, coming out of private real estate. There's a huge target to that now. It's nowhere near that target. And given the outlook and the respective outlook of the two asset classes, we continue to think that makes sense until we update the asset allocation and the investment policy statement. So on page 20, quickly, you can just see how the trust has grown over time over the past 5 years, almost doubling in value given contributions and strong investment gains. On page 21, again, this is information that we showed earlier, obviously much more detailed given the complexity of the trust. In the first half of the page, the net cash flow is really indicative of a couple of things. Again, any ETF will pay a dividend that goes into cash. And then the rest of the numbers really illustrating a lot of the changes that were made in February as far as liquidating managers, adding new managers, trimming, adding to allocations, all with the intention of bringing that balance of value versus growth back into line. And then once you get to the bottom half of the page, starting with the first green ring fund, any net cash flow is just a capital call or a distribution being made during quarter one, and if a firm had multiples of those, it's just netted out on that page. On page 22, you can see the total at the bottom, and those numbers will obviously match the cash flow that I'd shown on the previous page. So there's a lot of data on that page, but there's a lot of moving pieces certainly in any given quarter. It won't necessarily look that drastic in future quarters because we've made a lot of changes in the equities and fixed income. But as far as the private markets are concerned, there's many, many capital calls and distributions coming in and quarter out. So if you skip ahead to page, when we go to page 26, the pages we're skipping over are largely the ones that we looked at LOSAP as far as more granular information on asset allocation. If you look on page 26, again, this is the peer rankings page. So again, please look at the bottom table, those bottom two rows. So you can see the retired benefit trust, the return of 2.9% was a little bit below the median for the quarter. Again, well ahead of the policy index. And again, we would expect that to be revised up probably closer to 4% once we get those final numbers, which will hopefully put us in the top quartile eventually. So we always have to take those shorter term returns with a little bit of a grain of salt because we don't have the updated numbers. But also importantly, if you look fiscal year to date, 21/7, If we expect that to be closer to 23 at the end of the first quarter, as we stand here today, it's probably closer to 26-ish. So similar to the LoSAP, once the actuarial evaluation report is done, maybe on an annual basis for OPEB, or is that biannual? Biannual.
Biannual.
No, biannual too. So a good cushion for this year as we look forward to fiscal year 22 and can ascertain the impact on the fund. You know, in case fiscal year 22 isn't as good or an average year, we still have that big cushion that will help us from a funded ratio perspective. And then as you work your way from left to right there, you can see the more intermediate and long-term returns, more or less in line or slightly ahead of the policy, strong results relative to the peer group, but most importantly, strong results relative to that assumed rate of return of 6%, which that coupled with the contributions has helped the fund grow into a very strong funded status as we stand here today. So if we can skip ahead to page 29 here, we'll talk a little bit about some of the investment managers and then round our discussion out with some comments on the private markets and then the expenses as well. So on page 29, again, at the top there, that's the fund returns relative to the benchmark and the peer universe. So we've covered those. If you look at the U.S. equity composite there, you can see up 8.2% ahead of that benchmark. So what helped? Again, number one, taking a more balanced approach between value and growth in a quarter. That value did quite well. And if you look all the way down within the U.S. equity composite to one of the small cap growth managers, Friess, you can see they were up almost 22% for the quarter compared to 5% for the benchmark. So they had a very strong quarter. So back in February, if you recall, there were two small cap managers. They were both growth oriented. One was Friess, another one was a sub-advised fund by Nationwide that Geneva Capital ran. So at our recommendation, we said, you know, let's keep one of these managers and add ICM, who's a small cap value manager. So two things with that. Small cap value was actually up around 21% during the quarter, whereas small cap growth, you can see the benchmark for Friess just at 5%. So dialing back that growth exposure helpful, and the fact that Friess did so well relative to their benchmark, those two key factors really driving the outperformance of U.S. equities as a whole relative to the benchmark for the first quarter. If you move down the page and look at non-U.S. equities, you can see up a shade, up a shade under 3%, a little bit behind the benchmark for the quarter. Now, unlike U.S. equities, value did outperform in non-U.S. markets, but not nearly to the extent that they did within the U.S. So when we think about some of the changes that were made, it's pretty simple. If we look at the two managers that have been around, of Schwab International at 4.5 and then WCM at 0, they were at almost equal allocations when we met in February. We dialed back the growth and added the international, but even within those 2 months, if we just average the 4.5 and the 0, that comes out to around 2.2-ish. So making those changes and adding the value manager, you get to see the benefits since the composite was up 2.8. So well north of what would have been had we just left the allocations as they were. So we skip ahead to page 30, a quick comment on emerging markets here, and then we'll circle up to fixed income. So you can see emerging markets composite, again, the weighted average of the two managers up 2.5 versus 2.3 for the benchmark. Again, if you recall, those were the two managers in the fund, but the relative allocations were very, very different. It was about 75 to 80% to Invesco, which is sort of an active growth manager, and then the residual was in the index fund. And at our recommendation, the committee approved essentially flipping that on its head to, again, get more balance. So you can see, again, the asset class slightly ahead of the benchmark in an environment where Invesco was quite a bit behind. So again, making those changes, a more balanced approach, at least in the short term, aiding the fund relative to those benchmarks. We'll talk more about that. We'll skip the REITs. It's just a passive index fund. The hedge fund, just quickly, intrinsic, you can see there in the middle of the page, long short equity manager, meaning they buy stocks that they expect to go up in prices, but they sell short stocks essentially betting against the prices of these companies. So it's what's called a sort of a long short or equity hedge. They don't have as much exposure to the broad market as a normal investment manager because they're betting on some and betting against some. But you can see relative to their benchmark, another strong quarter for them and really strong across all time periods. So they're a firm that we know quite well, we think pretty highly of. They do a very good job, not necessarily every quarter, but over the intermediate and longer term, they're one that's delivered quite consistently. So let's skip over the private equity, private real estate, and high yield. We'll look at these numbers in just a second through the end of the year. And at the bottom of page 31, you can see the fixed income composite. So as I mentioned earlier, the fixed income composite or the asset class ahead of the benchmark by about 70 basis points during the quarter. The two active managers, Delaware Diversified and Loomis, both ahead of the benchmark, again, having a little bit more money in more aggressive areas of the fixed income market. But again, if you average those two manager returns, and we'll call it, 2.9 or 3.0, that was well below the asset class of negative 2.7, meaning that the addition of Lord Abbett in late February and early March also had a positive impact at the total portfolio level as rates continued to rise. Having less interest rate exposure was helpful in Q1. Let me pause for a second. Any questions or comments about that information before we look at the private markets investments? No. All right. So if you please turn to page 32, just some quick comments on the private markets, and then we'll look at the fees. So page 32 here, this page should look pretty familiar. I believe you've seen it in the past. So we're showing the private equity firms from top to bottom here, the commitment amounts, the vintage year. The first column is basically, think of that as an inception date. The unfunded commitment or what's left for these managers to call, and then some other information. But the key information, if you look all the way to the right under performance and IRR, what that stands for is internal rate of return. It's what's called a dollar weighted return. It's different than the returns we're showing on the previous pages, but it is a comparable return, meaning that in the grand scheme of things, what we're hoping for really in the aggregate, if you look all the way down at the bottom in the blue and all the way to the right at 22%. A good number for that is really mid-teens to high teens. So this private market program has worked exceptionally well over the years. Now, as we think about moving forward in the context of the asset allocation, we talked a lot about we're a really good place right now from a funded ratio perspective. We might begin drawing on this fund for liquidity purposes. So when we think about the asset allocation with illiquidity in the back of our minds, when we shift gears to the asset allocation study, like we discussed at our last meeting, talking about, pretty sizable material improvements in the illiquidity profile of the fund itself. Now that we're in such a good position, let's try to protect that moving forward through, less illiquidity, just to decrease that risk of having to sell something at the wrong time to meet any liquidity needs. But also when we think about the private markets, this is a very diverse program, meaning that there's a lot of managers in here. What we would like to focus on moving forward and don't have any recommendations for today is in the private markets, investment manager performance tends to be persistent, meaning that the best managers historically tend to be the best managers moving forward. So it's very different from public equities where manager returns are more cyclical. They can move in and out of favor over time. So when we look at this list, managers that are our favorite managers amongst these, Greenspring, most notably, we have a very long relationship with that firm, many, many mutual clients. They've done an exceptional job. If you look at, I guess it's the fifth row down through the seventh, they're secondaries funds, and they go all the way to the right, performance in sort of this 40% range. They are out in the market right now with their secondaries fund 5. So when, don't want to get ahead of myself, but if we have a July meeting for OPEB as well, talk about another commitment to that fund. And then similar to that, Accolade, more towards the bottom of the page, maybe the fifth up from the bottom, they are also out in the market raising a new fund, and you can see the returns all the way to the right. So in sum, as we move forward here, Drawing down this allocation doesn't necessarily mean we don't make any commitments moving forward. It means we make fewer ones and we focus on the best managers within the current profile. So just to give you, some context on our thinking, and in advance of the next meeting, we're going to be providing a couple recommendation memos for the upcoming Greenspring and Accolades funds. And then those managers will likely not be in the market next year. So we might make 2 commitments this year or recommend 2, and then next year, maybe none at all, depending who's in the market. And over time, those fewer commitments will help draw down the allocation a little bit and improve that liquidity profile. If you look on page 33, just quickly, this is the private real estate overview. If you look at the bottom of the page, all the way to the right in that blue, that IRR 13, private real estate, we're not looking for anything like private equity by any stretch of the imagination, probably something in the 10 to 15% range. So this is in line with expectations. Obviously, some of these more recent funds with vintage years in 2020, like the Chesapeake Six Fund, Pennybacker, and the Elm Tree Lease, were committed to an environment, unfortunately, that couldn't have been foreseen amid the pandemic. So as we start to get more numbers out of them over the next couple years, it'll be interesting to see those IRRs and how they play out. But with all that said, with dislocation comes opportunity. So it could be something as we look maybe later this year or early next year, is there an appropriate fund out there that could take advantage of some of that dislocation that we've seen in the market, most notably, say, on the office side, the retail side, or maybe a more focused manager focusing on other more growth sectors like the industrial sector, like the senior housing sector, things of that nature. So to wrap up with the private markets quickly, if you look on page 34, for the private debt investments, just 4 managers here, 4 commitments. Again, Golub and Ironsides managers we think very highly of. If you look on that bottom blue row and work your way all the way to the right, about a 9.5% return. So you would expect it to be lower than the other 2 because you're not locking up your money and you're making a debt investment, not an equity investment. So if we compare that to what's available in the public markets right now on high yield, it's really about 4 to 5%. So for locking up money for 8 to 10 years, you're getting paid essentially double that, which is exactly what you want. You want to get paid for that illiquidity. That's been happening historically. As we move forward here again, maybe a commitment here and there, but with the liquidity profile or the changing liquidity profile in mind as we move forward. So with all that said, I wanted to draw your attention to page 37 as we wrap up here with our fee discussion. So similar to the OPEB, obviously these pages are a little bit lengthier given the number of investments. So if you look on page, again, 37 in the middle in that blue column, all the way to the right, the estimated annual fee about 61 basis points. So that's largely driven by the private markets investments having a large allocation. I would say comparable funds are probably more in that 40 to 50 basis point range, but it's important to recognize that the returns that we've shown throughout this book are net of all these fees. So to echo Commissioner Hewitt's comments earlier on, certainly gotten what you've paid for it with this trust, and by all stretch of the imaginations, it certainly helped it grow into the strong funded status as we sit here today.
Right.
So with all that said, again, please let me pause. Happy to answer any questions or comments before we shift gears into the rest of the agenda.
We need a motion to accept the portfolio update.
We do.
Okay, we'll entertain one.
I'll make a motion to accept the Marquette Associates portfolio update for the quarter ending March 31st, 2021.
I'll second.
Thank you. All in favor, say aye.
Aye.
Ayes have it, motion carries. Next, Mr. Wing, and I apologize for calling you Winger, I don't know. I was close.
That's actually my nickname, so.
I apologize for Mr. Wing. And now we move on to your recommendations.
All right, great. Well, thank you. So this will be in the second book in the handout earlier on, just to switch gears there. And when everybody has that in front of them, if you could please hop behind Exhibit 1 to the recommendations. So this would be found on page 4. So similar to our discussions earlier this morning, a couple of takeaways on this page. Number one, if you look at the total assets up top there, you can see pretty much through the end of May, $115.7 million. So at the end of Q1, we were at 110.7, but now that we have more of the Q1 private markets statements coupled with equities doing quite well, $5 million higher as we stand here today. So a strong start to the second quarter by any stretch of the imagination. Another thing before we get in the granularity of the recommendations, always important to think about asset allocation. Where do we stand now? So again, this is the bottom left chart, and I apologize for how big this text is, but there's a lot of investments on this page, so it's difficult to get on one page here. But again, all of the respective asset classes are listed on the left. The black are the allocations, blue targets, and then green overweight, red underweight. So again, we ended the month about 6 percentage points, close to 6.5 percentage points overweight equities. Again, this is largely funded from an underweight to private real estate, and we continue to think that makes sense given the environment. Now, as far as the rebalancing itself, if you focus again back on that top chart, in the middle of the page, a few things going on here. Number one, as they've done in advance of previous meetings, Greenspring has made another stock distribution. So normally these distributions will be in cash, but they've been distributing the stock. It is not on the Schwab platform as we stand here today. I expect it to be in early next week, but this is a very good value of what that estimate is because we know the number of shares and we have the recent price. So like we've done previously with these stock distributions, it would be our recommendation to sell that investment and have it go into cash. Now, when we think about cash, if you work your way all the way down to that first table with the cash on the left there, it's grown quite a bit since we last met as distributions have outnumbered capital calls for the private markets investment. So we think it's a good time to put some of this money to work and still maintain a reasonable cash allocation after we've done so. So 2 recommendations for the board to consider. Number one, in the middle of that page, we're recommending $1 million additional allocation to the Lord Abbett Short Duration Income Fund. Again, this is a fund that has less interest rate sensitivity, focuses on the 1 to 3 area of the bond market. Still has a yield in the neighborhood of, say, 1.5 to 1.6%. So you're not getting a lot of interest rate risk, still a decent amount of yield, and obviously that's well north of what is on cash these days. So that would also still even decrease more slightly the interest rate exposure within fixed income because they have much lower risk there. And then the other key recommendation, you could see a $450,000 purchase of that Vanguard Real Estate ETF. Again, we saw the REITs outperform in Q1. They've had it continue to be pretty strong here in Q2 as the economic activity or recovery continues to unfold. So it's not a large contribution, really just bringing it in line with its strategic target. When we think about where to put cash to work, obviously we already have pretty decent overweight to equities. We're talking about a small allocation of fixed income. So what's left? Basically the REIT allocation. So we think it makes sense to put some of that cash to work into REITs and bring it back up to its target. These recommendations are outlined more clearly on page 5 for the specific ones of what would be increased and what would be decreased. And I'll pause there for a second for any committee comments or questions around it.
What was Roblox?
I'm sorry, what is it?
What is it?
It's a game that my son plays way too much.
My daughter, my granddaughter too. My wife just bought her $25 worth of Robux.
Robux.
Yeah.
Robux, yes.
What a rip.
Pains
Well,
me.
what a good idea. What a
pains
good
me.
idea.
Roblox is an online gaming platform
Yeah.
where it's cloud-based and users can create their own games.
Yeah.
So it's very interactive. And basically, how the company makes its fees is it's free to play, but if you create your own games, that might be a little bit of a fee. But to buy these Robux as well, because that gives you, I don't even know. I don't know. Maybe a sword in a game, or something like that. You can buy things for your player. You're the image of yourself. So it really kind of swept the nation amid the pandemic. Certainly swept my household and my neighborhood.
My granddaughter too. And I'll say to you, you're exactly right. My granddaughter had her 9th birthday, and she got a $25 Robux thing from her yaya, her grandmother. And she was so happy because now she can go and buy something else that gives her more status in this Roblox world.
Oh yeah.
And what, a husband and wife or somebody figured that thing out.
Is that true? I
Out
don't
there
know
for
that.
kids to play, and then, it's like that guy that did Amazon that, wanted to start that idea, or eBay. I mean, it's amazing.
It is.
Anyway, I mean, I'm sorry to see us getting out of it. I know that.
Well, from a fiduciary perspective, we don't do individual security analysis, right, on specific companies and specific stocks. So I couldn't, as a fiduciary, aren't comfortable keeping it in the fund. What I can tell you is you've already experienced a large gain because Greenspring made this investment at a cost per share of around $4.50, and it's trading for 90 plus.
Yeah, no.
So they made quite a lot of money for their underlying investors here. And so the recommendation would be to take those chips off the table and move them elsewhere.
Okay. No, I'm good with it.
Yeah, I mean, it all makes sense to me. I mean, basically, cash is, zero risk to, high risk, and what you propose to move $1 million of it is just basically the next rung up, correct?
Exactly.
I mean,
Yeah.
So
This short term.
Right,
I think
right.
that's the ticket.
so.
All right, so I'm going to make a motion that the committee approve the proposed rebalancing with that we liquidate Roblox shares and move $184 to cash.
I think it's
I'm sorry?
184,000, right?
184,000?
Yeah.
All right, 184. Move 1 million from cash to Lord Abbott, short duration income, and 450,000 in cash to Vanguard Real Estate ETFs.
I have a motion. Do I have a second?
I'll second.
All in favor, say aye. Aye. Ayes have it. Motion carries. Thank you.
Okay, great. So let's skip behind the next exhibit and we'll get into the asset allocation study. And before we jump in, obviously the purpose of this exercise is the exact same that we walked through earlier. But when we think about the trust and the OPEB versus the LOSAP, so incredibly different, right? By how it's invested, the strength of the fund, the potential for upcoming liquidity needs, things of that nature. Now, at the same time, when we think about improving the liquidity profile, any asset allocation software doesn't necessarily make that clear. And what I mean by that is when you look at the return and the risk numbers that we'll see here shortly, if you had 100% in private markets, that would be the quote unquote optimal portfolio, right? Because number one, they're the highest returners and they don't have nearly as much volatility as public markets because they're just marked on a quarterly basis. Those companies aren't traded day in and day out and things like that. So from a total portfolio perspective, if you just think about that in isolation and ignore funded ratio, ignore liquidity needs, then the more alts, the better. But obviously, we have to take those other factors into consideration. So with all that said, let's hop into page 7 here. Not to spend too much time on it, we looked at these returns earlier on, but if you look below that black column here, we're also showing some of the private markets alternatives investments, starting with really opportunistic real estate. So that would be consistent with what is in the trust itself now. Also, private infrastructure, we talked a little bit about that last meeting, private equity, debt, and hedge funds themselves. So we still think the returns in those areas are going to provide a premium to public markets as they've done over the long term. but in absolute terms, they might not be as high, just given markets both in the public and private markets are a little bit overvalued. But with that said, on page 8, a quick breakdown, a similar sort of 3 portfolio exercise here, and I'll get through the granularity and the differences. But at a high level, if you think about the current, the target to fully illiquid assets is really opportunistic real estate, which is towards the bottom, private debt and private equity. So these are investments that can be locked up anywhere between 8, 10, or even 15 years. So the current policy calls for 29% to those areas. In addition to that, the hedge fund allocation of 3% is more of a, call it semi-liquid asset. So all in, we're thinking about a third of the portfolio that doesn't necessarily have, on-demand or daily liquidity, if you will. If you work your way from left to right up at the top here, what we're calling is lower alts and then lower alts V2, the key differences really are in the liquidity profile. So if we think about those fully illiquid assets, what we're talking about here is really dialing back the opportunistic real estate found towards the bottom of that middle column from 10 to 4, which is in line with the current allocation. Dialing back private debt and dialing back private equity by just a percentage point, because like I talked about, that's going to take time to really dial that back. So when we think about the fully illiquid part of the portfolio, will come down to from 29 to 21. So about a 25% improvement in liquidity, if you will. Now, as far as semi-illiquid assets, again, we'd have those hedge funds in the middle of the page. Right now, it's about a 2% allocation, so we can just knock down that target. And then also the addition of global infrastructure that we talked about at the last meeting, that's more of a semi-liquid type asset. So illiquidity, if you were sort of all in, would come down from 32 to 27, but the fully illiquid investments would come down most dramatically. And then the lower alts V2 is a similar exercise, but just saying, well, if we want to improve the liquidity further, we can nix the hedge funds all together and just move that into core fixed income, make a more conservative type of approach. So where does the money go? Really in equities. Right now, in between U.S., non-U.S. equities, you add those up, it's only about 44% of the fund. In version 1 and 2, it's at 51%. So moving those monies out of, higher returning private markets into higher returning public equities. And then the other key difference, as I noted, knocking down the opportunistic real estate, knocking down the private debt and private equity, and then adding global infrastructure as part of that inflation sensitive or inflation insurance bucket within the portfolio.
I guess
Yes.
my question is, and I mean, personally, I've never been a fan of real estate, but I've never had a portfolio so large that I had to diversify in so many different ways. So I get that, but I'm trying to, I'm looking at your opportunistic real estate, and you guys gauge it at like 11.4% over the, which is, quite high, but at the same time, you're telling us to get out, right?
Not get out, but
Well,
lower
lower from,
strategic target allocation. Yeah, so when we think about private markets, if we're going to lock up that money, we want to do it in the most, or sort of where we expect the highest return. So we'll be knocking down that allocation, but not too many changes to private equity and private debt. So-
because opportunistic real estate is usually in the private funds.
Correct.
Right.
Correct. Yeah. So that money, just like the other two,
Right.
is locked up for
Locked up.
like 10 to 12 years. Yeah.
So while it might be a better, right, I follow.
Yep.
Makes sense.
And see, I go with the lower alt 2 on this one, just because I believe as we get more, we need to take less risk of losing it. And when I see a term opportunistic,
That's high risk?
it makes me think that way
Right,
anyway.
right.
Yeah. So
I got you.
again, we got this fund to 116 million. And when we started talking, and I look at this fund as a potential relief valve if FY '24 comes in. We've heard other counties, Charles and Calvert, say, hey, we're looking for bad years after the stimulus goes away, that this could be a potential source for us to fund, whether it be EMTs or whatever it be. But we got to be careful that we don't lose some of it, or we don't.
Right.
So I'm more along the lines of going to a conservative approach now that I've kind of gotten to the number that I was
You don't want to lose it.
supposed to
Right.
get to.
All right.
So just to be clear, and I maybe misunderstood you, Commissioner, so I don't want to speak out of turn, but so that the assets for the trust itself are irrevocable unless they're for benefit payments, so.
Would be the pay-go, we would,
Right, so you're talking about just reimbursing.
Oh, no, yeah, we've,
right, right.
that was a
Meaning
long
we would not contribute
$30,000 or
as much.
$40,000
Okay,
study
okay.
too.
Okay, I apologize, just want to make sure.
Right, me
no,
too, me too.
Money is fungible, but not in this.
Right,
No, we're
right.
two different things.
Okay, okay.
Which would then speak to the need for liquidity, because if we weren't
Yes.
contributing,
That's what I'm saying.
the pay-go would come
Then
from
we
the
would have to
trust.
use some of the monies in
Right.
the trust to help pay for the pay-go, right?
Right,
Pay-
right,
Pay the fees.
Right.
and that's still the
Kind
expectation.
of what SORP's doing. you
Right.
know.
Right.
Right,
Right.
right, exactly.
We're not gonna pay salaries out of OPEB.
No, I don't think we're. But again, it gets to be,
Right.
it's kind of like when you've won some money, take it and go home. Don't keep, the longer you hang around, the more shots I get at you.
Well, last month, we made the decision to kind of dial back on
And
the.
go in this direction.
Yeah, so this is in line with what we talked about last month.
Exactly, exactly. Yeah, the broad takeaway is improving liquidity
Right.
and then sort of restructuring that inflationary type bucket, not to include just the real estate, but also infrastructure. Right, yeah, so this is largely in line with what we discussed.
As Commissioner Hewitt said, it's almost like Alt-2, because like with Alt-2, you get rid of the hedge funds. You get-
Yeah.
Right, I'm with you.
I prefer that.
Right.
The riskier stuff.
Right, right.
Exactly, exactly.
I agree with that, so
Okay.
I don't,
All two.
sounds like we're all on the same page. Ms.
HR.
Bratton?
Yes, I agree as well. Yes, I'm sorry,
That's
yes.
all right.
I'm sitting here
Don't mean to
nodding,
pick on you.
sorry.
Great.
I mean, I'm happy to walk through the rest of this, but if the committee's in unison, then I want to be
Yeah.
cognizant of your time.
Right.
Yeah, but again, as long as this thing keeps growing, buddy, you're welcome. Quits growing,
Right,
anyway, I'm sorry. I'm just kidding you.
right. No, that makes sense to me, so I guess do we need a motion on that, or he's coming back with that? So,
I think it'd be the same, right, that we would have
Yeah,
an
get more
asset
than-
allocation.
You would come back with,
No.
Yep.
right.
We
Excuse me,
would-
I'm sorry.
With
an
the
investment
IPS.
policy statement.
Yeah, so what
Right.
we'll do with both meetings next time, we'll have the fund allocations, things change, any recommendations, and then we'll walk through an investment policy statement, from a best practice perspective, things like that, and then incorporate this into that.
Right.
that makes sense to me, so that would move us to the custody overview?
Yep.
Mr. Wing?
All right, thank you. So we have had a number of meetings this year, and at those meetings, we've talked about next steps, and this is, I apologize, this is behind Exhibit 3. And talking about, what other things we want to attempt to tackle, and custody being one of them. So just a quick overview of things to consider. We did reach out and get some informal pricing type of things, and then we'll talk about, sort of the roadmap ahead here to wrap up. So on page 18, just quickly, and we're talking about, the three funds in aggregate here. Obviously, the OPEB and the LOSEP are custodied at Schwab, as you all well know. The SORP is custodied at Wells Fargo. And when we think about, custodians, it's a commoditized business, right? It's hard to differentiate yourself. So we think about how custodians can do it. I'd really argue these first three bullet points here. Number one, fees, obviously very important. Number two, investment options. Normally, that's not something we have to be cognizant of, but if you recall at Schwab, we have all the options, but we don't have access to all the cheapest share classes. So we made a conversion or two earlier this year, but we don't have access to them. And when I say we, I really mean most institutional investors for those cheaper share classes. So that's of utmost importance. And then finally, client service. And you can't necessarily put a price on that, and I don't want to speak for any other staff, but it's challenging, I think, to say the least, to work with Schwab on some issues as far as getting things done, getting responses and things like that. And there's time. That's time and money and opportunity cost. So that's not necessarily captured in a hard dollar amount.
You're saying they're harder to work with?
Correct. And then in addition to that, the last three bullet points there, we just want to make sure, and most institutional quality banks do all this, right? They track the investments custodied elsewhere, so the alternatives aren't held at the bank, they're held elsewhere. So they track the values, the wires, the calls, and then particularly for the SORP, obviously experience with benefit payments and drop experience, given the changes upcoming, or excuse me, the first drop payments being made at the beginning of next year. So very, very important as well. So on page 19, just a quick look at the table showing all of the services, if you will, on the left, and then the fee schedules for Wells Fargo and Schwab. And the first key takeaway, you look at Schwab and you think, you see 0, 0, 0, 0, 0, 0, 0. Well, how do they make money? Well, what those broker-type platforms do is they make it easier and more cost-effective for you to use their funds, like a mutual fund, like an ETF, things of that nature. So they don't make any, they probably lose money on the custody side of things, but then they make it up through the back end, making it easier, less or more cost effective, again, to use their ETFs, to use their funds. And obviously those have expenses and fees. So that's where they kind of make up the money for investors custodied on their platform. So on page 20, a quick estimate of what the fees are now. What about say annual run rate, if you will. You can see Wells Fargo, and those numbers in parentheses were numbers that they had passed along, which were very helpful about, what was actually occurring as far as, the SORP. And then again, to the right, the only thing we're really paying on Schwab is wire fees, and you can see the summation below in their dark gray. But again, there's an opportunity cost because we don't have access to those lowest cost share classes, and we footnoted that. And we estimate that to be about $23,000 essentially in foregone fee savings, right? So that's I would argue.
Still works out to a cheaper cost.
It still works out to a cheaper cost, certainly, for the two funds there. So in aggregate, you could see Schwab probably about, with that $23,000, close to 24, Wells Fargo a little north of 42. So in aggregate, about 66 grand all in. So on page 21, what we had done is really reach out to a couple of the major players. Number one, U.S. Bank. They don't have a lot of exposure in the Maryland market, but they're a very good, strong bank that we work with closely. We reached out to Wells Fargo and said, hey, on an informal basis, what kind of fees were we looking like if, the OPEB and the LOSAP moved it under your purview? And then Wilmington Trust, who is a major player amongst Maryland counties. Every other Maryland county we work with, which is 4 or 5, including yourselves, uses Wilmington Trust as the custodian. So they're a major player in the Maryland market. But the key takeaways here as far as the fee differences, and again, these are informal proposals. The market value fee for Wells Fargo, you can see 2.5 basis points, on the order of maybe 50% higher or so than the other two funds. They would also have an annual account fee of $2,000. So what that means, 3 accounts, OPEB, LOSAP, SORP. So that would have an underlying fee of $2,000 per each of those accounts, whereas the other two are nominal or zero. And then finally below, in those last two rows where you see security holdings. So what that means is these banks mirroring the investment values for the private markets investments, essentially collecting those statements and then incorporating it into their own statements. So Wells Fargo does that right now for SORP, but Schwab does not do that for the private markets. So U.S. Bank and Wilmington Trust would have a material charge per those funds to do that, whereas Wells Fargo basically would not charge to do that. So those are really the 2 or 3 key differences in the fee schedules for the three. And in summation, if you look on page 22, now, instead of the fee schedule, we're putting it into an actual dollar amount. So again, if you look at that market value fee up top, Wells Fargo about 50% higher than the other two. The annual account fee, obviously a little bit higher as well, but then they wouldn't have too many other costs in addition to that. If you look at those bottom 2 rows, just as the large takeaway, we'll start with the total fees, and there's a footnote there US Bank did say that there would be a minimal fee for the LoSAP, and we would estimate that that total fee would be about approximately $2,500 higher, so call it, a little north of 70,000, which would be in line with Wells Fargo. And then Wilmington Trust at about 61, so call it, 10 to 12% below the other two. The other thing we wanted to put in here, just for reference, is the total fees excluding security holding. So I think it's my understanding the county would like the banks to continue to incorporate that. It's not done right now for the OPEB and the LoSAP. So if you didn't want the banks to do it, obviously the fees will come down quite dramatically. But I would say industry practice is for the bank to incorporate those values for helps with, internally, reconciliation, and then I'm sure with the auditors as well. So as we think about all this and put the pieces together, this was an informal type of reach out and proposal to these banks. It's my hope that if, as you look to the next page and we talk about an RFP, that competition usually breeds lower fees.
Yeah.
So, I think, based on conversations I've had with some staff, this was a proposed timeline that Ms. Pratson and I discussed maybe a few weeks ago. Maybe just looking today for board approval to, just put it out to bid. Maybe July, taking it to the commissioners if that moves forward. In August, September, posting the RFP, we would be integrally involved in that, working with county staff and procurement to develop the RFP to help with anything along the way. Evaluation and selection towards the end of the year, and then a Q1 transition, if appropriate. So with all that said, happy to answer any questions or comments about that proposal.
You don't get any additional money out of this, do you?
No.
It's part of their,
I just had to hear you say that.
Do we need, this is just a question, do we need commissioner approval to put the RFP out?
probably not, but I know that we went that route when we did the investment manager
Okay.
and just said that this is what the boards are thinking of and this is the plan. So I think as a courtesy and to follow that,
Okay.
I would recommend that we do that.
I don't think it's a bad idea, at least keep them on board.
Right, for
That's all.
transparency, right.
And something to consider when we do, if we do have the RFP, is that if we are potentially or conceivably going to have benefit payments from OPEB, the amount of benefit payments will significantly increase.
Well, I think that would just be a reimbursement, right? Or would you be making the payments directly to the participants? Usually we see it the former, not the latter.
Right.
It would be.
So it would just be
paying-
a wire fee.
Oh, okay,
Right.
okay.
Right.
That's right, because it's paying the Care First bill. It's not participant payments, that's right.
Right.
Okay, okay. I would say, and Jeanette, correct me if you feel differently, that there's a lot of interest among the SORT board to have to change custodians.
Yes.
And
I'm
Wells,
not on the soap.
right.
We
And one of the reasons is that a couple of years ago, Morgan Stanley uncovered that Wells Fargo was keeping fees that they should not have been. So there was some discomfort among the board about that. And then also Wells Fargo is transitioning to principal this fall. They sold their business, their line of business, this custody, and they're transitioning. So there's concern, I think, with the board among that as well.
The new people?
Just the unknown. You know, since we're changing anyway, we might as well be active about it rather than passive and just go to
Good,
principal.
proactive, let's say.
Right.
Well, it seems to make sense if one of the funds wants to go in a new direction, the other two should take a look, no?
And that was one of the reasons for the RFP for the investment manager, is
Right.
to consolidate the
Right.
funds to
Right.
try to save money. So that would be one of the goals, is to consolidate the custody.
As well.
think it
Doesn't
makes
sound like a
sense.
bad idea.
That makes sense, yeah.
Yeah.
I agree.
So are we looking for a motion on that, or?
All right.
Yeah.
Okay, you want a motion or consensus?
I guess either. Yeah, that what we would do is we would, we intend
Oh,
to
right,
present
'cause-
this to SORP in June. And then with the board's approval, we would bring it forward to the commissioners in July.
Right. No, that's good.
Okay.
Or
It's
consensus.
Consensus is
Yeah, I think
fine.
consensus
I
is
think we
fine.
have,
Fine, yeah,
yeah.
Okay, that works for me.
yeah. Perfect. That would end Mr. Wing's presentation, I believe, and that would get us to the plan administrator report, which would be Ms. Quasny.
Thank you. So the first item on the report is the capital call distributions, and since our last meeting, the fund distributed $1,343,631.43 in cash for the capital calls. The fund has also paid some administrative expenses. Bolton Partners, $17,500 for OPEB special projects. Riggs, Councilman, Michaels, and Downs, $18,140 for fiduciary insurance. And Whiteford, Taylor, and Preston, $225 for legal services. For the calendar meetings coming up, we have a meeting scheduled for August 27th and December 3rd.
Now, are we going to add another meeting for OPEB like we did for LoSAP? Do we?
Do you recommend that, Pat? Do you think?
Yes, I think that would be great. We largely cover the same items in July on both and just keep us on the same path as the SORP as we move forward here.
So are we looking at doing the
Same
3 for
day?
3, July
Yeah, July
22nd?
22nd.
You really picked a good vacation.
Yeah,
Can we all go too?
But it makes sense. I mean, it
It
makes
does.
sense to knock it out.
yeah, I agree.
So I think we would
Small
probably
bites.
need a motion to change the calendar, right?
Yes.
To add a
Yeah.
special meeting.
Yeah, I'll make a motion to change the calendar, and I have our next meeting on June 22nd,
July 22nd.
July 22nd.
Second.
All in favor, say aye.
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 Motion carries. Think, do we need a motion to accept the plan administrator report? I will.
I'll make a motion to accept the plan administrator report.
I'll second.
All in favor, say aye.
Aye.
Motion carries. And if there's nothing else, as they say, for the good of the order, I'll entertain a motion to adjourn.
So moved.
Second.
All in favor, say aye.
Aye.
Thank you, ayes have it. Meeting adjourned.
Thank you.
Not even close to.